Hi, welcome to another Learn, Grow, Invest meeting. It is very good to be here with you. It feels like it's so long in between these meetings. I think we should have more, but it's not all my decision. So before we get into it, I want to welcome all our new subscribers, new followers on social media, everyone who has joined the community over the last few weeks. Welcome. We are going to talk about a very interesting one today. It's the question of how many stocks should you hold, and I'll be having this. So I'll do a quick presentation, and then I'll discuss it with Chike, and it should be a very interesting conversation because I think we're on opposite sides of the spectrum. So I'm focusing on one strategy now. Chike is focusing on one himself. And so we have very long conversations about this topic. I know I'm right, but Chike has not really accepted the fact that I'm right yet. So I'm waiting for him to catch up, all of that stuff. So we're just gonna, discuss this topic. I'm gonna share some things with you from a balanced perspective, and then we just kind of have this conversation that we normally have, and then hopefully you find some value from that. I'm going to ask you now to like the video, to share the video with another investor, and help us grow this community. As customary here, I'm going to open with a word of prayer, and then we'll just jump right in. So Heavenly Father, thank you so much for this day. We thank you for the ability to meet like this as a community. We pray, Lord, that you will give us wisdom on this topic, that you'll give us insight into the best strategy for our investments. And I pray, Lord, that for everyone watching this video, that they will be successful at their own investing as a result of watching this video. We thank you, Lord, again, in Jesus' name. Amen. All right. So, let me jump right into it. I see Chike is here. Hey, Chike. You want to say a quick hi before we start?
Hi, everyone. And I caught exactly what you said. Everything. That's nice. Yes, he's not lying, and I will never join him. I told him this to the very end. I'll stay how I am.
And we were talking about this just today, and so I keep telling him to just do things my way. It'll work out better for him. He never listens to me, but
Nope.
It's fine.
Nope.
Amen. So I'll just give a shout out to some persons before I start. Ashley was here from very, very early. Hey Ashley. I think it's Richardo. Dane is here. Shani is here. CM is here. Deborah is here. Everyone, thank you so much for joining. Christine is here. Nikita is here. Hey, Nikita. I can't wait for you guys to meet Nikita. Thank you so much for joining. And yeah, so let's start. So before I get into this, I'm going to ask you guys, how many stocks do you think you should hold? So I'm going to ask you to post it in the chat now. How many stocks do you think is the right number? All right, and let's hear what you have to say about it. So this topic is one that every investor has to answer at some point, right? Because you start to buy stocks typically as somebody who is brand new. You buy the stock, you may buy a couple of IPOs, you may have been holding some for a while. And then before you know it, you may have 10, 15, maybe 20 stocks in your portfolio. And then you realize something, it's very hard to track and to understand where every single stock is going. And you may or may not know. So you may be up 200% on one, but you're like, is it the right time to sell? I don't know. You may be down, 30, 40, 50% on another one, and you're like, is it the right time to sell? It's very hard to answer that question, right? So I'm seeing some of these comments here. Somebody says, as much as you can afford. That's interesting. I don't know if I agree with that personally, because think about it this way. If you buy 1 unit of each stock, then you can afford all the stocks, right? But would that be a good decision? I'm seeing somebody saying depends on your appetite. And that's interesting. I'll frame that a little bit soon. Another person saying 10 to 15. That's actually an interesting number. 10 for or 4 to 5 long term. I think minimum 10 if you're a long-term investor. Interesting. So, and I see Justin here, depends on the portfolio value, but less than 10. And that's a very interesting point, and we'll dig into that a little later. So max is 10 is a great place to be. You should be able to track them readily. That's an excellent point, Shani. All right, so let me get into this, right? So the factors to consider. So before you answer the question as to how many stocks, you should understand a few things, right? So I saw some persons were alluding to it, but I'm just gonna give you the full gamut of what you should be considering, right? So the first thing that you want to do is think about your personal financial goals. So each of us here would be investing for a very different reason. So my reason for investing is different from yours. We may have a similar goal in terms of making profit, but the amount is different. The time horizon is different. The things that we want to do with the money is different. So it really starts there. So before you say I should have 5, is 5 enough? Is 10 enough? It really depends on what your personal goal is. And it says personal, meaning it's different for each person. The next thing you want to do is think about how long. So some person said, 10 or 4 to 5 long term. That's an interesting thing to think about, because if you're holding it long term, some persons actually say do 10 to 15 if it's long term. It really, I would say you have to kind of combine all the factors. Let's see what the rest of them are. Risk profile is one. So for persons who don't understand what a risk profile is, it's essentially your risk makeup. So so each person has a unique risk appetite, right? So for me, I may be considered aggressive, or depending on who I'm next to, there are persons who are more aggressive than I am. So it really depends on what your risk profile is. If you don't like risk, or you're what some would consider risk averse, then that would lean towards a certain number. And it's interesting, I'll ask you guys, do you think if you're risk averse, you should hold more stocks or less stocks? Let me know in the comments below. The next thing you want to do is think about the market conditions. So the market conditions should determine how many stocks you hold. So for example, during COVID last year, what I did was start to plan a portfolio rebalance, because when we saw what was happening and shaping up, I said, well, some stocks that I'm holding right now, it may not make sense for the next year. So I started to, maybe take some profit in some, add to my position in others based on what I thought the climate would have given me. So the market conditions have a role to play in that. And the last thing is really your ability to research and manage a portfolio. So for those who say 15 stocks, how often can you track those 15 stocks? There are some companies where you may say, well, I don't need to worry about them, just buy this one and forget it for 5, 10, 15 years. I'm not so sure about that, right? So I believe in the value of maximizing your dollar. So if you have a stock that's not doing well, and I had this conversation with Chike just this morning. If I have money in a stock that's not necessarily doing well, and I look maybe for the next year or two, another stock that's maybe a little bit more attractive, I would take a short-term loss, move to another stock, build up some profit in the short term, and maybe go back to that same stock later on. Now, Chike would disagree and say, well, if you leave that stock now, you may be buying it at a higher price later, but that's not necessarily true, because stocks don't only go up. So sometimes it's hard to think about the stock being lower than the price it is now, but I'll tell you, it can still go lower, right? So it really depends on what the market is doing. All right, so your particular profile is what should really determine how many stocks you hold, and we'll get to that magic number later on, but I'm just setting that framework now. So I say I see some person saying if you're risk averse, you should have less stocks. That's actually not what the theorists state. So there are persons who think that the more risk averse you are, the more stocks you should hold, and I'll tell you why soon. All right. So so your investor profile is all the things that I would have stated on the previous slide that goes into who you are. So your risk profile, your personal time horizon, your profitability needs. So some of you would need more cash quickly. Others you may want to just preserve your wealth, and then for others it's like you want to just invest well. You don't really have an amount that you're aiming for. It's good to just determine what those profit targets are and make sure that it's meaningful for you. And then really we try to narrow it down into 3 main categories, but you can have varying degrees of this. So for example, I'm moderately aggressive, I like to say. You know, Chike, if you speak to him for 5 minutes, you'll find that he's more on the conservative side, and then a little bit to moderate, and it doesn't mean it's right or wrong. There is no right or wrong here. It really depends on what your makeup is and how that factors into the other things you're trying to decide on. So as Justin saying, the longer your time horizon, the riskier the security. You want to phrase that another way, Justin? Phrase that another way. All right, so we did a survey on Twitter, and if you're not following us on Twitter, by the way, L.E.A.R.N Invest on Twitter, please follow us now. So we did this survey, and this was quite surprising to me, right? So we asked persons how many stocks are in their portfolio right now, and 45% of them said 0 to 5, and I was shocked because I thought this would have been closer to 11 to 20, and that's because for the reasons that I stated before, because sometimes we find ourselves holding on to stocks and we don't even know why. But it's interesting to see you know, this number. So let me know if where you fall within this survey in the comments. Just let me know how much stocks you're holding right now. All right, so the way to answer the question of how many stocks to hold. So we spoke about risk appetite and risk profile. We spoke about, you know, long-term goals, short-term goals, and there's this conversation. So thanks, Ashley. Thanks, Denniston. So that's what I thought, right? So most persons I thought would have been closer to that range. And I see Tamara saying 6 to 10. That's actually an interesting number. So if it is that you are risk averse, diversification is what you're gonna look for. If you are a little bit more aggressive, or you are able to find well-researched companies and make solid bets, then concentration may be what you should look at. So I'll explain what these terms mean. So concentration is known to build wealth, and let me tell you why I say that. Now, you may not agree with me, but hear me out. So if you think about the wealthiest persons in the world, they're known to be affiliated or holding a sizable amount of stock in 1 or 2 companies, right? So you think about the Bill Gates or the Jeff Bezos, they may own other stocks, but you know, their billions of net worth is probably hinged on 1 company. That's concentration. So concentration is when you put all of your money, all of your assets, all of your capital into a very small pool of stocks. So some persons say 5 or less, some persons say 10 or less. So I tend to think 10 or less is okay. And if you think about it, when you see that list of top 10 shareholders, that is concentration, because it's not saying that those top 10 shareholders don't own other stocks, but it's not likely that they'll hold the same amount. And if you're trying to figure out what concentration means, if you have, let's say, if you have 10 million and 6 million, 7 million is in 1 stock, that's a very concentrated portfolio. So for those persons who are sharing the number of stocks they're holding, how, based on the capital of your portfolio, is that balanced throughout? So for the persons holding 10, if your portfolio is $1,000, is it like maybe $100 each? Is it 400 in one, 50 in 9 others? What's that makeup? Because you could be holding a slightly concentrated portfolio based on what it is that you have, right? And then the thought process is diversification preserves wealth, because persons who diversify typically want to limit their risk. And so they'll tell you the reasons that you diversify is to account for one stock going up while another one is going down. Typically, they don't tell you to diversify to build wealth. They tell you to diversify to protect from the risk that is inherent in the market. All right. All right. So we asked this question on Twitter as well, and it's actually split in the middle, which is interesting, right? Because, and I wonder again here if persons really understand what concentration means, because I'll show you some sample portfolios later, and you tell me whether or not you think they are concentrated or diversified. All right. But this is the feedback that we got from our Twitter poll. Again, if you're not following us there, please do so. All right. So I'm going to talk a little bit more on diversification. So it reduces risk, which is what we spoke about, but it limits the potential for capital gains, right? So in thinking about the number of stocks that you want to hold, if it is that you're saying, well, I want to hold 10 to 15, understand that depending on how those are correlated, and I'll explain correlation soon. If it is that you are holding maybe stocks in the same industry, maybe stocks of the same market, depending on what those securities are, you could be reducing your potential for capital gains, right? So think about it this way. You may have, or for those who have that stock that is 100%, 200%, 300%, and then you have some that you're making a loss on. When you look at that average of your portfolio, the percentage is lower because that portfolio is diversified. So if you think about it, so it's the same for me. So there are stocks in my portfolio now that I'm up 400%, but there are also stocks that I'm down 40 or 50%. So my overall profit is somewhere in, it's less than triple digits, and that's because I'm at one point my portfolio may have been too diversified, right? So the more diversified your portfolio is, you would actually move closer to how the market moves. So you hear this concept of persons wanting to beat the market. If your plan is to beat the market, then diversification may not be what would work for you. And as I said, it's something that persons look forward to because it reduces the impact of volatility of any individual stock. So if one is going really bad, but another is going well, then if you should cash out that portfolio, you may still be out. But if you maybe had fewer stocks, the outcome might be different, right? So there's this concept that you should understand called negative correlation, right? So what that means is that, and this is kind of getting a little bit technical because I'm hoping to explain to you what diversification truly is. So there are some persons who attempt to diversify, but they're not really diversifying. Meaning, if you have companies that are positively correlated, meaning, let's say that you're holding 6 financial companies out of the 10, you're not really diversified, right? Now, it's not necessarily a bad portfolio, but you need to understand what diversification truly means. So you want to diversify with companies that are negatively correlated, which means, for example, if you're holding a mail pack and let's say you next one is maybe indies, the industries aren't the same. So typically, if something is happening to impact male pack, it's likely not be able to impact indies. And well, I mean, certain things like maybe, let's say, fees or duties of products that might be ordered, maybe something along those lines. But the idea is when one company or a group of companies goes up, the next one should not be impacted. So that's what we mean by negative correlation. So the importance is that it's key for persons who actually want to have a diversified portfolio, because that way it can withstand volatility. So one of the things that caused me to change my strategy last year is that I realized that I was weighted in financial companies. So I actually decided to consolidate the number of financial companies I was holding, because I'm like, well, a lot of these, based on my assessment, are going to be positively correlated. And so it doesn't make sense to hold so many financial companies. I'll just bring that down and then say, well, let me reduce that number. And so sure, one could say, well, when those sectors recover, then my portfolio is good, but we don't know when that will be. We never know what the future will hold. So in the short term, I decided to change some of those positions, went to other companies. My portfolio is doing better, and I have more balance in that portfolio. So you may want to look at that makeup that you have, right? All right, so this is what persons would consider a diversified portfolio. Now, there are two ways to diversify. Well, two of possibly more ways, but two that I can think of. You can diversify in one asset class, or you can diversify among varied asset class. So this example here, this portfolio has cash in it. It has large cap stocks, small cap stocks, emerging market stocks, government bonds. So this would be a reasonably diversified portfolio. And typically, if you going to see a financial advisor, fill out that risk profile, tell them that you're conservative, tell them that you're not really familiar with investing and you want them to guide you, they'll lean you towards a portfolio that looks something like this. So they'll say, well, you know, buy some bonds, buy an equity fund, buy some stocks, and they'll present this portfolio to you. But depending on if your risk profile changes or whether or not it can meet your future goals, this portfolio may not actually give you the returns that you want. And this is sometimes what happens, where persons will start out a certain way, they're learning and they're growing, and then it's like they're like, why am I not making more money as I'm learning and growing? And that's because your portfolio makeup is probably not as updated with your current investor profile. All right. So this is an example that I thought I'd share. So let's say that we have a quote unquote balanced portfolio. So there's this number that they say that if you want to know how much you should have in stocks, you should minus your age from 110, and you put that amount in stocks in terms of percentage, and the rest in something that is not positively correlated, so bonds or something else that's of a lower risk. So if you're 30, then they would say maybe 80% of your portfolio should be in stocks. If you're 20, 90% of your portfolio should be in stocks. And then as you get older, you adjust your portfolio. That's one theory. I'm not sure I necessarily subscribe to that, but I'm just sharing with you what the theories say. So in year one, we may have stocks giving us 20%, then we have bonds 5%. So the overall return on that portfolio would be 14. Now I already hear what some of you are saying. Well, if we had just bought stocks, then we'd be up 20%, we're good. But if we just bought bonds, we'd be up 5%. Both of those things are true. And then when we think about what happened last year in terms of COVID, yeah, minus your age from 110, Ashley, and then that's the number that some persons think that you should hold in stocks. Now, again, I'm just sharing with you the information. I don't necessarily agree with that, but that's what most companies would actually advise you to do in terms of that that investor profile test and then a recommendation for how we should build a balanced portfolio. So let's say the second year now, when stocks have no return 5%, let's say it's a year like last year, and then the bonds may do a slightly better, your overall return would have been 1%. But think about it the same way again. If you had just stocks, you would be down. But because you had some bonds, maybe you save yourself from a loss and you broke even. No, so it really depends on how you want to build that portfolio. So the idea or the advantage of diversification is having that protection when it is that the market doesn't respond favorably to the asset class that you're holding. So you can diversify in many ways. So for example, for persons who invest solely in real estate, if the value of their properties aren't appreciating, then you may want to look at something else. Persons who invest in stocks only, you may want to find something that's not as volatile. Persons who invest in like maybe digital currencies or US stocks or there are many ways to do this. The idea of diversification is that you offset the risk inherent in that primary asset class with something else. So for those of you who are just joining, I'm not telling you to diversify. I'm presenting to you the information for you to be able to decide how many stocks will be right for you. All right. And then with this example, what if we were just in equities? So on year one would be good, but in year two would actually realize a loss, right? So an approach of maybe diversification could work. I don't know, right? All right, so I'll talk about now a concentrated portfolio. And so personally, this is the type of portfolio that I'm leaning towards. I'm not telling you to do the same. I'm just telling you where I am in terms of headspace as an investor. And I'm going to share with you at the end the reason why I think concentration works for me. So remember a few slides back, I would have said, concentration builds wealth and diversification preserves wealth. And if you think about it, concentration means that you're holding 10 or less stocks and you're putting all of your capital into those 10 or fewer stocks. So think about it this way. If you have $10,000 per month to invest over the next 5 years, 10 years, 15 years. So $10,000 per month would be 120 per year. For 10 years, that's 1.2 million. To have that amount invested in only 10 companies, then you would have quite a number of units in those 10 companies. There's nothing to say that you can't switch out those companies at any time. And building a strong portfolio of solid companies. Your research is limited. The time that you have to worry about the different industries are limited. And your dividends will also be considerably more than if you were to just hold 20, 30 companies and you're getting maybe $100 dividend check or $200 dividend check as opposed to maybe $1,000 or $2,000, right? So just, something to think about there. So the concentrated portfolio does come with more risk, but it comes with a higher reward. So it really depends, again, that very first slide we showed, what's your personal goal, what's your time horizon, what's your risk appetite? Because I know, so persons want high reward without the risk. It's not going to work that way, right? There's no sure bet in terms of an investment. So you really just want to make, it's okay for me, I think, to make solid picks. Even again, today I was saying to Chike that I decided to close a position in a company, and we were talking about why. And I said to him, well, I've met my profit target, so I think it's time to exit. And he was like, well, the financials are coming out soon. What if so and so happened? I said, that's fine, because I don't need to hold the stock longer than it takes for me to achieve the goal for which I held it for. Right? And sometimes, again, we find that situation where we're holding on to a stock because it was our first stock, or we're waiting to break even, or we're waiting to reach 100%, and we may have we're hoarding stocks. So when we had that minimalism episode, we spoke about this, that some persons can actually have too many stocks or more stocks than they actually should have, because they just don't want to let it go. Like the stock means something more to them. It's like this special gift, So it's okay to treat it in a way where you've done the research, you've decided that a particular company does not meet your preferences anymore, and you shift to another one that in your view, because it's somewhat subjective. I mean, some persons argue that fundamentals are there, the industry is there, things are sure bets, but I don't necessarily subscribe to that, because it's all unknown. The future is all unknown, right? So there are two extremes that you can have in terms of concentration. So all right, Jess, I see that. So I understand what you mean, but you see, at some point, think about it this way: if you are emotional about your very first stock, and especially if that stock is not meeting your preferences right now, there could be something else that closely meets who you are currently as an investor. Why are you holding on to that first stock, right? So think about the two extremes in this way. There are persons who move to like a diluted portfolio, 25, 30 stocks in multiple places as well. And if that sounds familiar to you, that's pretty much what a unit trust would be, or maybe some equity funds would be. It's essentially a basket of stocks, or a basket of things that's why sometimes they do not perform according to investor expectations, and that's because it's a lot of stocks. So you may have some winners in it that do really well, but then you may have a few key stocks that drag down the performance of that portfolio, and then after a year or two, it's grown 5%, 10%, and you're like, I thought this unit trust was good. It's not a bad unit trust, it's just maybe not the best vehicle for you at that time, right? So a highly concentrated portfolio would be one stock. So think about what I was saying before. Those persons who are wealthy, your portfolio is heavily concentrated, right? So because if you have $1 billion in one stock, even if you have 20 more valued at 5 million or 10 million or 20 million, if you lose that primary one, or that goes down by half, your net worth is gone down. Which part you want me to repeat, Jess? Which part? So I was saying that if for those persons who to be wealthy, their net worth or the value of their portfolio would be concentrated usually in one or two stocks. So if it is that they might hold other stocks, it's still a concentrated portfolio, because maybe more than 90% of their net worth is in one particular stock. So if that stock loses value, their net worth is significantly hit. And that's why you will see, for example, a news article that says, Jeff Bezos just lost $10 billion on his net worth. And that's because he has a concentrated portfolio. It's based, primarily on one stock. So there are benefits to it, right? At the same time, you may hear that, okay, I'll repeat that soon. So you may hear that, Elon Musk net worth went up by X amount. Again, that's a side effect of concentration. So because it's concentrated, when it goes up, it's great. But also the inverse is true. So I was saying, with a unit trust, depending on the makeup of the trust, it could be possibly considered a dilution in terms of concentration, because there are way too many assets for you to see any significant growth. And that's because maybe the portfolio is spread too thin in terms of the unit trust. And typically you can see what stocks make up a unit trust by just asking for the documentation. So you can ask a company to tell you what stocks or what makes up that trust. And then you can look and see whether or not that makeup of companies meets what you're looking for. All right, so I have this sample portfolio here. Can anyone tell me which equity this is or which fund this is?
Am I allowed to answer?
No, GK.
Right, I'm gone again.
So based on what you're seeing on the screen, can you say which fund has these set of stocks? Yes, Shani. All right, so it is Select F. Would you consider this a concentrated portfolio or a diversified portfolio based on everything that we just discussed? Yes, Jess, you definitely can ask. Your every single unit trust or equity fund should have a makeup. So sometimes it's not in the brochure. You should be able to ask the representative to tell you how it is being invested. All right. Yes, Tamara. So it is a concentrated portfolio of stocks, and that's because if you look at the top three stocks make up 70% of the portfolio. All right. So you have, Panjam, that's fourth, JMMB fifth, Barita sixth, and that accounts for maybe 17%. So if you really consider like the top six, it has a whole lot more that I couldn't even share. But it means basically how the top. So imagine that now, right? So they're heavily weighted in NCB. NCB went from 250 to 140. So imagine now the value of that portfolio going way down just because 35% of the weighting in this makeup of stocks is in one stock. And then as you know, Sagicor went down as well, Scotia went down as well. So now 70% of your portfolio has gone down, and that's again a side effect of concentration. It's not necessarily a good or bad thing. It's a part of the process of investing. Now, if it is that the market recovers and NCB gets back to its former highs and they're all doing well, persons who would have bought now or persons who are holding will be very happy, but they would have to deal with the risk that is happening right now, because based on the concentration of the portfolio, it is going to go through what it's going through now because it's heavily weighted in all of these stocks. So if you think about it, I can't even think about one stock that's probably doing well here. Maybe Barita, is doing the best out of all of these stocks I'm seeing right here. Chike, you can probably let me know if I'm wrong. Is it Barita the best out of all of these here?
Currently, yes.
But Barita is just 7% of the index.
Just the weighting.
Right? So even if Barita doubles in value, it's not going to move the portfolio by much because it's being negatively impacted by everything else. And that's the power and also the disadvantage of a concentrated portfolio, right? So this is another portfolio that I'll ask you guys to name for me. Chike, you're not allowed to name it. Which portfolio does this look like? I know a few of you holding this stock as well.
Actually, I'm lost. I don't know this.
You don't know? Wow. Dane is here. Dane knows the answer.
I know technically my portfolio looks kind of like this, but yeah.
No, so there are 45 persons in the meeting right now. Nobody knows. There you go. So this is QAI, right? How does it look, Chike? This is QAI's portfolio.
Interesting.
Exactly. Right. So it is very important, guys, to actually take a look. So you're holding a company that is holding other companies. It's very important to know what's in the makeup of the stock that you're holding. Now, QWI got a short increase recently because persons were expecting, say you have stocks that did well, like Seprod has done well, Mailpack has done well. Oh, okay, I understand, Deborah. So I'll try to zoom in, but this is QWI we're talking about, right? So there are stocks here that have done well, but then again, the same issue that we had before, you have stocks that have not done well, right? So because of that impact, you now have a situation where if 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 the portfolio was just made up of Mailpack and Seprod and Carib Cement, then all of QWI's holders would be very happy. Now, I'm not saying you shouldn't buy QWI now. I'm just so remember we're dissecting it to understand what is made up of it. Because if we're holding QWI, we need to understand what it's made up of to understand whether or not we've made a good investment or not. All right. So based on I would look at two things here: the weighting of the stocks, similar to the previous one we looked at, because that will tell me. So what I say to persons all the time: if you are going to take a stock like this, so now there are pros and cons, right? But one of the things I consider, if you're going to go into a stock that may be concentrated or positioned in a certain way for other stocks, two things, right? One, it may or may not make sense for you to hold. So for example, there may be persons who hold QWI and then hold separate JMMB, NCB, Mailpack, JP, and Carib Cement. You understand what I mean? So you may have persons who are holding both, or persons who hold Select F and have NCB and have JMMB and have Barita. It's again, if it's doing well, you're good. If it's not, then both would be suffering. All right. All right. So there are ways that you can diversify, right? So as I was saying before, you can focus on different industries. You can vary market cap. You can actually, there are some brokerages now that allow you to invest in the overseas market. There are persons who balance their portfolio, some growth stocks, some value stocks. That's actually something that I do. Well, everything here on the list I've actually done at some point. And then you have different asset classes. So one of the things that I do is that I look at different asset classes that I invest in over time, because that gives me some amount of protection from risk, because I still need to diversify asset classes, but I'm leaning towards a concentrated portfolio because on one hand, I'm diversified across many assets, but I want to concentrate my stock portfolio so that I get the maximum returns out of the stock portfolio. Now, as I said before, if it is that the market is not doing well, or there's some crash or recession, that portfolio is going to take a hit, but it is not the full makeup of my portfolio. So if I lose all of my stocks right now, if my portfolio completely wipes out, my net worth is still preserved because a small percentage of my portfolio is actually stocks, right? So you can concentrate in stocks and diversify across assets. And so that's something to consider. All right. So to answer the question, I know that everybody's here for, how many stocks? You see it on the screen. There's no single correct answer. So the right number of stocks for Chike, it's not the right number for me. It's not the right number for Shani or Tamara or Dane. All right. So it really depends on everything that I've said so far. So you have to kind of determine based on those factors, understanding your portfolio, see if it's the right company, the right industry, the right product, the right prospect, and then you can start to build your portfolio in the right way to meet your goal. Now, so there are persons who invest to maintain their money and stay ahead of inflation, then diversification is what you should look for. If there are persons who are pursuing and trying to build wealth, concentration is what I would say, which means 10 or less. If you're looking to preserve wealth, then look somewhere between 10 to 20 is what I would recommend, because that's a healthy enough size where it shouldn't take you too much to track, but it still takes a certain amount of time. And so I leave that to you really as a reasonable range. So somewhere between 0 to 20 is what I would say. But if your goal is wealth building, I would say focus on 10 or less. If your focus is to limit risk or losses, then you want to look somewhere between 11 to 20. And I don't know why we went this far without saying this, but nothing that I've said so far is financial advice. This is for the purposes of education. We're sharing and discussing as investors here. So I'm sharing my perspective. You know, you're free to share yours in the comments and let me know. And there's a tip that I'll share with you now. So there's this strategy that I use once per year called portfolio rebalancing, right? So what portfolio rebalancing does, it allows me to shift my stocks, that my portfolio that now maybe overweighted in something else, into the target allocation. And what I mean by this is, you buy a stock that, let's say you have 2 stocks, right? I'm going to make it really simple. You have 2 stocks. One stock is up 200%, right? So you have 2 stocks valued at, one is 30,000, one is 20,000. So you have a 50,000 value portfolio. If you wanted to have 50% in one, 50% in the other, your portfolio would have drifted in the sense that you have now 60% of one and 40% of the other. If you sell 10%, not 10%, if you sell $10,000 worth, no, $5,000 worth of the one that's up 30 and put it into the one that's valued 20, you would have balanced your portfolio, right? Okay, so let me zoom in. Let me do this instead for persons who can't see it. All right, so I'm just gonna zoom in so you guys can see it. That doesn't work. Try one more time. Okay, so I'm gonna zoom in. Is that better now? So what I was saying is that, so one was 60, one was 40, and then the portfolio drifted, meaning, and all this could mean is that the value of this portfolio went up, right? So they're having a good run, their stocks are going up, and so it was started at 60-40, but now it's at 70-30, and that's because the person's stock portfolio is actually doing well, and that can cause your portfolio to become out of balance or more concentrated towards one stock. What you can do is essentially rebalance that portfolio by selling off that amount that is excess and putting it into the other class, right? So this works with stocks, it works with different asset classes, and it goes into the topic of asset allocation, which is something that we'll cover in a future meeting. But it is something that I practice personally. It's something that I recommend that you consider if you are investing. Now, all of this that I've said today applies to persons who invest. If you're trading, it's a completely different strategy. If you're trading, we actually need to have a different type of conversation about how many stocks is the right amount. But our content here is geared towards investors first. And trust me, we're going to be coming out with some content for traders very soon. So you definitely want to stay tuned for that. All right. So there is a concept that I'll leave you with, modern portfolio theory. Let me zoom out. So modern portfolio theory is actually something that I speak with Lisa about, a couple of times. We've mentioned it. I introduced it to Chike last night. Did you research it, Chike?
That I did. I did a proper read of it.
So what are your thoughts on it? Sounds interesting.
Yeah, it actually does. And while I'm still grappling with the whole, it's around investors that are risk averse. To be very honest, actually, no. To be very honest, I'm now grappling with the fact of, am I really risk averse based on what I'm doing? To be very honest.
I tell you, so it's there's nothing wrong with being risk averse in a Chike. It's just understanding who you are, and based on what I know of you, the type of decisions that you make, how you go about selecting your portfolio, you are a little bit risk averse and that's okay, right? So I don't want anybody to think that being risk averse is a bad thing, right?
Yeah.
It's persons who are risk averse can typically sleep a little bit better because they've kind of built up these kind of things around them that makes them feel comfortable with their portfolio, so they know that they're not going to wake up and see any wild swings. Now, there are persons who are aggressive, but they can't deal with the volatility. I would just say it could be just a mental thing. It could be just practicing, understanding how it works, being more informed. But you always want to invest or trade according to your specific risk appetite and investor profile. You don't want to be out of character. So if you are risk averse, then you should act accordingly. If you're not, then you're not, right? So the modern portfolio theory is this concept of building a portfolio that's meant to maximize your returns. So you want to look at the stocks that are negatively correlated. You want to say, okay, let me build a portfolio that based on the aggregate return, I'm going to, it's going to fall within a certain range. If it does well, then my upside is this. If it does poorly, then my downside is still sort of capped based on, how the market may move. So it's really based on the assumption that you want to have a certain level of risk that you don't want to be subjected to. And it's something that I think it's worth researching. So, just do a YouTube search for it, look it up, tell us, what you think below this video. I'll try to link it on our Twitter page, a video on modern portfolio theory. Tell us what you think about it. All right. So we're at that stage now, guys, Q&A. So let us know if you have any questions.
They've had a lot to absorb.
Yeah.
Chat's been quiet for a while.
Yeah. I don't know if that's a good thing or a bad thing.
That's actually a good thing. One of the takeaways was mentioned earlier, and I actually didn't. You see, a lot of these things, and it's good to learn, right? Because a lot of the stuff that you've mentioned tonight, in a way, I'm pretty sure that each and every one of us, as we've become investors, etc., and we've started investing, we're doing this in one shape or form, but we actually don't know that it's actually this that we're doing, right? So this helps to put structure. For instance, the one with the portfolio weight, in terms of how much based on your age that you're supposed to be in. And that's pretty much similar to your net worth calculation. But funnily enough, as I did the calculation roughly just now with my age against what I'm currently invested in, I'm technically right there, and I didn't even know that's exactly what I was doing. It's just that, I mean, for me, I have confidence in my investing, not just the investing strategy, because that changes, but I have confidence in one particular type of asset class, right?
Mhm.
I know what the others can in terms of the requirement for diversification, but I have the confidence in one type of asset class, and I'm heavily concentrated in that asset class as such,
Ah,
right? So, um, so yeah, what we get now is how you've broken up. So you're concentrated and you're diversified, but it depends on what you're concentrated in, and it depends on what you're diversified and how you're diversified overall, right? So yeah, when you learn that, I mean, I would just generally again remind, because everybody knows me on the other side of being, the long term. It's about the time horizon. At the end of the day, um, given enough time, if you've done your research and you're doing what you're doing, it works. What you've invested in works out for you, right? At some point, the thing about this here, as you rightfully said throughout the presentation, is can you handle the volatility? Because what goes up must come down, and what goes up, or should I say goes down, doesn't always have to go back up, right? So it depends
exactly.
on so um I mean, yeah, it's time. It's really about your your time horizon is the biggest one. It really
Yeah.
is,
So
because
what I find happens a lot, right? So and a lot of I saw somebody tweet this as well today. There are times when you want to, so there are persons who will say, I'm a long-term investor, and they're acting out of character to what a long-term investor should do. If you're a long-term investor, you if you're a long-term investor, you're not buying stocks asking if it's going up in a month.
correct.
That's not what a long-term investor should do. No, there's nothing wrong with buying a stock and trading. That's completely fine, right? So it's okay to do that, but don't again act out of character. So if it is that you want to be a long-term investor, but you also want to trade, that's fine, because Chika and I discuss it all the time.
Kind of
That's
the
me.
balance. Yeah.
So exactly. So I have a balanced perspective. I have some stocks that I will not touch because I'm buying them for 5 years, 10 years. I don't even look at that portfolio. I don't track it. But then there are others that if it is that it changes, my priorities change, or things that I'm looking at may change, I'll sell those, I'll take profit, I'll get rid of them because I have short-term goals that I want to meet, and it doesn't benefit me in terms of my estimation to hold on to that stock anymore. So Jess, I actually love dividends too, and that's a part of the reason why I'm aiming towards concentration, because concentration gives you better dividends.
Same
Right?
here.
So think about it. If you have 20 stocks, don't think that hey, you have 20 stocks, you're getting more dividends. The sum total of those dividends may not add up to if you had 5 stocks or 10 stocks and getting dividends from those 10 as opposed to 20.
And we just had that discussion, by the way.
We just
Yeah,
yeah.
earlier on. And that
All
was
right.
true. I mean, dependent on the company, dependent on the company. Let's stick with the company because we're talking about dividends. Dependent on the company that you buy, if this is where you look at you're looking at the dividend yield, etc.
Yeah.
Holding a company that can give you more units, right? That has a higher dividend yield than the other, might be to your advantage at the end of the day, dependent on which ones you pick, and who you're in. So I mean, yeah, it's not completely one-sided, based on and you might have to actually, for the ones that are higher, that's the thing too that caught me as just is something. If you don't look at it, you should look at it. So for a company, let's take for instance any company that is over $20, right? They pay you a dividend of, say for instance, 30 cents. So for every unit you buy, you have to spend $20, and you're gonna get back 30 cents on that unit there. That rough maths is just about 1%.
That's less than 1%.
Right, it's less than 1%, right? But now you find a good company, or should I say a company that is in a phase of growth, or maybe they had a good year, and that company costs only $5 to buy, and their dividend that they're about to pay is basically like $10, right? Sorry, not $10, like 10 cents instead, or even 15 cents. When you do the dividend yield on that, it works out to be better, and you can purchase if there is enough volume on the market to be sold. You can purchase much more, right?
Yeah.
So it goes to finding that that right balance. Of course, if the company is less to buy, then you really should be doing your homework very well to make sure that all of the prospects of this company to continue paying that dividend that they've been paying every single year so far is sustainable, pretty much, right? So yeah.
So I mean, again, so everything that we're saying here, guys, we will never ever tell you which stock to buy, right? Because it's not about the particular stock, right? So some of the things that we're working on, some of the strategies that we look at, it's for you to determine what stock meets that criteria for you. So this conversation we're having about dividends is something that we spoke about. So dividend yield is something that Chika and I speak about. I look at it just based on the cash that I get in my hands. But Chika's perspective is right. If you have a lower price stock, then ultimately you get a better yield on that money. And so it's lower in price, which means you can buy more and you get a similar, if not, well, no, it wouldn't be similar, it would be a greater dividend yield. Then it may make sense. And that would be a good reason to maybe temporarily come out of one stock to go to the next, right? So think about stuff like that. So let me explain what Jess was asking. So I was saying that what I do, so one thing is that I'm building towards a concentrated portfolio, right? So I'm building towards, I'm not quite there yet to actually have 11. Do I have 11 stocks? I don't remember. I think I have 11 or 12, right? But I'm slowly consolidating because I'm building towards getting under 10. And I have a certain target number that I'm getting to in terms of units, right? So I have about 6 stocks that I am making a bet in a short term that they'll be able to give me enough cash, whether it be dividends, whether it be capital gains. And now what I do is whenever I rebalance, I take the profit from those 6, or I close out the position altogether and I add it to my long-term position, right? So I'm taking the profits from one set of stocks and I'm putting it on my long-term position. That's kind of been my strategy over the last few years. So there are certain stocks that I don't ever think about selling them. I don't ever think about how they're doing. If they go down 30, 40%, I don't touch them. And that's because I understand the industry enough to say, well, I know it may fluctuate. I know I could maybe employ a better strategy with this company, but my key thing for those stocks is that I'm looking to get heavy volume, heavy concentration in those companies. So 5 years from now, 10 years from now, if I have 1 million units of them, I'm happy with that and I'm comfortable with that. And so that my long-term portfolio, I'll let that stay. But my short-term portfolio, if I meet my profit targets for all of them this week, I'll sell all of them and just keep cash and wait for another opportunity, right? So Hilda is asking what's the average growth rate of a company on the stock market. I mean, there are over 80 companies, I think, on the Jamaica market. I think the average growth rate, would that be the performance of the entire market, Chika? Is that pretty much the way to answer that?
I'm not sure. Because when I saw the question, I was focusing on the specific company and how long it normally takes the company of itself to get up there.
Yeah, it would be hard to answer that question. All right.
Yeah. So yeah. There's a theory that I'm about to throw out to everybody, which is a monkey wrench to the entire discussion. about number of stocks to hold. For those who might have read or will read later on the book, The Little Book That Beats the Markets. Well, that was the original one. The updated one is The Little Book That Still Beats the Markets. There's a theory for mature markets. So that would be the United States, looking at the S&P 500, looking at the Russell 2000, etc., or looking at European markets, stocks 600, etc. You need a large number of companies on the particular market. You basically go out, you look at the price to earnings of a bunch of companies, and then you look at the book value of a bunch of companies, and basically put the two together. And if they're very low, I can't remember exactly what it was, but it was in the book. You pick about 30 of them, and you buy 30, balance it how you want to balance it. I was just thinking that you'd keep it simple. So say for instance you have like 6,000 US. Yeah. You just spread 6,000 US across each one of them equally, right? And you then go ahead and leave the portfolio. So here's the part to kick off. You will have to have the utmost amount of patience, because more than likely the book states that for the first 2 years that you're holding the portfolio, it will go down. You will be in a loss.
Before you even go any further, Chike, that sounds like a diversification strategy.
Yeah, because it's going to go down?
No. Because it's 30 stocks.
Oh, well, true. Yeah, because you are picking. It actually does. Yeah.
30 stocks. So that's close to dilution.
I guess the kicker about it is, and I'm actually very interested to, and as I told you, I actually want to test this out, is that in the third year, the claim is that by the third year, everything turns, and basically it turns big, and just keeps, and all you do is, as it's diversified, and it's basically a scale. You then look now at the individual ones. So whichever one is no longer performing out of this, well, as I said, it's 30. You can hold more. It doesn't really matter, right? The criteria was that you're looking at PE and you're looking at book value, and you're putting the two together. Whichever one stops performing, you sell it off, and you replace it with something else, and then you have to give that one the same amount of time frame. But you're only replacing one stock or one company, and while you still have, say for instance, you have 30, you still have 29 working for you, right? You're not selling off the entire portfolio. It's an interesting book, and as I said, it's an interesting theory that I actually want to test in a more mature market. So, to see how it goes.
So that sounds like a diversification strategy. The only reason why I wouldn't do that, I think that sounds okay for an inexperienced investor. But if you, like Chike, based on what you know, based on your ability to value companies, if you spend your time, research valuing 10 solid companies, that, because remember, $6,000 per company by 30 is 180,000. 10 companies, that's 18,000 per company. You are now going to be in a better position with those 10 companies. So even if it's well researched, then you may have 6 that perform and 4 that don't. But you can always do that same strategy, move away from your losers, stay with your winners. So if you consolidate from that 10 to 6, again, that capital that you would have to put in is now in 6 stocks. You're still in a better position than 30, and then going through the portfolio and looking at that one, you get your 10-cent dividend check. Like, no, that's that. I don't.
Yeah, I think most of it. I think the theory is though is in that it's not gain to income. It's gain towards gains and price appreciation. In terms of the market price, because it's gonna go up. So you sell the ones that are no longer moving, until they stop performing. Again, it's interesting. For me personally, I hold 14 companies currently here.
14?
Yeah, hold 14, and I actually, well, if you remember, based off of our discussion last night, I started dumbing down one. Well, I just needed to, the one that was up exponentially is near 200% now. I basically decided that it's time to move away from a piece of it, not everything, and I'm going to something that I'm more confident in. That is less costs, and I firmly believe will make its move later on. So that has started. I started that today. I got a piece of it off the table. There's still another piece left, hopefully to buy tomorrow, and then I can start making the purchase of the other company that I want to, go into. And again, that is, as you said, that is, I have 14 is, I guess you might call that diversification, right? So it's because we're trying to get there, right? So, but then there's that, and then I'm further diversified.
I would look to see, Chike, out of that 14, are you concentrated to a particular industry? That's what I would assess, because if you're holding, so we showed Select F earlier. If you're holding Select F as one potential stock, then you have some other financial stock. You can assess that. If you're holding, let's say, Select M, which is manufacturing, but you're holding some of the manufacturing companies, you may be able to. So to me, and this is what I told persons in the past, is if you're holding Select F, but you have NCB and you have JMMB, why not just sell those stocks and buy more Select F? Because you'll have more units and Select F moves as those stocks would move, right? Because this is the same company. It's weighted so much in those top three. If you have those top three, I would get Select F. If it is that you're convinced these are solid companies, this is not a vote to buy or sell them. I'm just saying it makes sense to me if you have those top three companies in Select F plus Select F, why not just add more units to Select F? Because if those companies pay a dividend, then Select F is going to pay the same dividend based on the allocation again that it has.
Crux of the matter of that is that Select F hasn't paid a dividend if you're going to do that. And I'm going to say it this way. I'm going to say it on the back of this. I actually believe very much in Select F. So I hold a heavy concentration of my portfolio in it.
So hold on, Chike. So the companies, so if Select F has not paid a dividend, has the companies that Select F is holding, have they paid dividends? Because I don't follow Select F.
So last year, most of those companies actually, some of them did. The big ones that make up the big concentration of Select F, so like an NCB, they didn't. So if NCB pays, I guess it's there. But there's considerations for dividend payments this year. I mean, it's funny enough, the financial companies are actually looking at doing so. So, but again, I should say this, or repeat it again. My viewpoint of Select F has always been, because it tracks the financial sector like that, and it's weighted accordingly like that. It's not a short term. It's not supposed to be anything short term.
Shani is saying Select F paid a dividend
once, and it wasn't. Let me just remember. It wasn't. I'm talking about if it was recent, and it wasn't recent. Yes, we did get one. We got 1 cent, and that was in 2019, right? No, well, actually, don't scoff at that, because again, here we go. It's exactly what we were telling Jesse a short while ago. November 2019. Thank you, Shani. Correct. So we went through a whole, and we went through a whole year without one. So even though we got 1 cent, Jesse was. This is a great example about it. You would have been buying Select F at that time, $1.25. Highest I think was $1.50, right?
Yeah.
You could have bought, and this goes to your strategy that you like in terms of volume. You could have put down a serious amount of units there, and then you could have possibly eked out at that time, depending on how much you are holding. Let's see, what 1 cent on 600,000 units, basically, right?
No, it's even go smaller. Let's say the average person had 100 units.
Right. Yeah.
100,000 units.
100,000 units. Right.
I don't know.
But that's only going to be $1,000. That's $1,000. But then if they bought, they would have to had put up $100,000 basically, right? And again, that goes back to the dividend yield. It depends on what that price, that market price, to the dividend payment.
So for that dividend, so if I had 100,000 units of selected, what would be my dividend?
If you had bought it at say 125 at 1 cent,
Yeah.
and you put that to $1.25, yeah, that would have literally just been 0.8%, right?
That's how much is that in my hand in terms of cash?
100,000.
Yeah, if
100,000 units was $1,000.
$1,000.
Yeah.
And in 2 years, so you have no capital gains, you got $1,000 dividend check. Like, so to me, I mean, again, it's to each investor his own. I'm just saying, so let me leave it alone.
We had the conversation, but again, every investor is different. If you can sleep at, and I know again we will go down that road where people will be like, but why would you stay? Because if your objective is one that is extremely long term, you will stay right where you are. You will do other things. So for me personally, I have no problem where I am, and I have gone into other companies. So the overall stock portfolio, company portfolio is still up, right? It averages out and is still up. Yes, selective, and it is a hit on my portfolio, but I'm fine with that because I have been going long term, and that's my objective from day one when it was conceptualized, brought out to public, etc. I link it immediately back to index funds, which we can't buy, which we don't offer here directly in Jamaica, right? And it's the closest thing that is tracking against the financial index of Jamaica. So
this is the case that I always make to you. And guys in the comments, let me know how you feel about this. I think in a situation like that, where let's say the first month of COVID, everybody was thrown off, fine. The pandemic would have been showing you what companies are likely to survive it, whether through cash, whether through their type of business model. And if you had selected at that point and you said, well, let me hold on to it, I think if a stock is down 30%, 40%, you do one out of two things. You either average down that stock, because if you bought at 125 and it went as low as I think 60 cents, if you bought equal number of units at 60 cents, your average price is now 90 cents. Right? So you bring down that average price, which means you don't have to wait until it gets back to 125. If it hits $1, you've made 10%. The second thing is you could take that loss. I know it feels like a lot, but you take that loss and you position into a company that matches the market conditions. That's what we said on the first slide, If you go to a stock that meets the climate that you're in, then you can maybe see some short-term capital gains. And then right now, or maybe a few months from now, you could have re-entered your selected position with probably more units than you have before and recovered for that loss you made. So to me, you can't hold the stock in your head like, I can't sell this because I'm down 20%, 30%. Like you don't lose the money and then it's lost forever. You can remake that money in another stock that matches the current market condition. That's just what I think.
Yeah, I mean, I don't disagree. Again, I just carry it depends on the investor that you are. So again, first rule of the long-term investor was supposed to be that you don't lose money. That's first rule of Buffett.
But so people, to me, you have to take that rule in context, because if I lose $10,000 on a trade right now and I make 20 on the next trade, have I lost money? I made $10,000.
Yeah, I get you. and it's agreeable, but it's not a given.
No, but Chike, none of it is a given because you can stay in that stock and with the hopes of not losing money, and that stock never recovers.
True.
Right? So you've lost 10, you say I'm not losing money. Rule 1. You down 20%, I'm not selling. Rule 1. 30%, I'm not selling. Meanwhile, there's another stock that you kind of like, you don't understand it fully, but it looks promising. You switch over to that stock, it's up 100%, 200%, 300%, and you're still holding a negative 30, 40% loss because rule 1 lose money.
Agreed. I mean, I could get behind that, and that's actually true. So it should be noted to the guests, and to the audience. Sorry, that I actually balanced out everything in that. Even though I am in Select with X, I have multiple other stock that I have put actually more than, it's not equal anymore. It's way more that have been put over because I understand those again, so that is fine. I mean, and the main thing I should say though, at least for me, my main goal has always been, or one of the main goals is, with the decisions that I make, can I sleep at night? And do they keep me up? The truth is, and I'll be honest, I take my loss, well, it's unrealized losses until I actually sell it. It's unrealized losses until we all actually sell it. You take your losses on the chin just like you have to take, and just like you celebrate your wins. So for me personally, and knowing your time horizon is the next thing too. So I guess with respect to specifically Select F, it's about my time horizon with it. The first thing about it is because of how I understand it or believe it. It has none where it gets completely, so unless it goes astronomically high for no reason at all, right? Which index funds are not index funds, but like setups of index funds don't normally do. They track along how all of the companies that it's associated with, perform. But that's enough for that. When you go to the singular companies, no, yes, if you do believe, and that's actually what we're doing now, if you do believe and you do understand how a particular company is performing, what is behind their performance, and what makes a dollar, how that the company makes a dollar, you have all confidence to go in as heavy as you want to and be comfortable with it. It should be that whatever decision you make, though, as Jeremy said it earlier on when he said he left one because he felt that he had obtained his profit. I said I was proud of him. You missed that. I said I was proud of you, because the conversation we always have is, don't get greedy. If you hit your target, if you hit your goal, accept your goal, because it will build and reinforce a particular character in you that you don't basically decide, you know what, it went to 100, can it go more? I can stay in a little bit longer. Funnily enough too, one of the persons that we always tweet earlier on before the session started, tweeted that it was Brian Feroldi. He tweeted, you have a stock, you have a company, it's $20. It went from 20 to 30, you're happy. And then it went from 30 back to 20 again, and you're unhappy because it went 20, 30, it was 20.
So what you said, it went 20 to 30, you're happy, but then it goes from 20 to 40 to 30 and you're upset.
Right. And you end up being unhappy. Right.
Yeah.
It's all about sticking to your goal. If you meet your goal, you meet your target, come out, be happy for whoever makes any extra on whatever they make, but be comfortable and content with your goal that you set.
But here's a thing that I always say. To me, it's at 20, went to 40. I would say, so this is what I shared with you today. If it's at 40, I would say, okay, cool. I have $20 that I didn't have before, right? I have 100%. My money doubled. I don't mind taking that profit or taking all of it even time on the market, because what I've realized, and this is what we discussed with Ryan a few months back. Markets have cycles, companies have
That's
cycles.
right.
So if you understand the company well enough, you understand how investors respond to that company, you understand when it's a good time to buy, you can possibly, if it is that, for example, that it's news of the stock, the stock price doing well, that brought it to 40 and it's a run up, right? You understand that there's typically a peak to that run up. Typically a peak. So if you take your profit at 40, there's nothing to say that when it goes back to 35 to 30, you can actually re-enter that position and you
Correct.
still have potentially more units than you had before. And then when it goes back to 40 or maybe higher, you would have benefited. You have some cash in your hand and that stock is still there sitting, but you'd have taken advantage of that short-term increase. And that's one of the things that I see a lot of investors miss. If it is that you're not trading, then it won't matter. If it's not trading, you want to enter at some solid price points. If you're not trading, there is still sometimes optimal times to buy. So I like to say I buy companies when nobody's talking about it. So if nobody's talking about your company, now is the time to buy it, because the companies that people are talking about, when they're talking about them, is not the best time to buy it, because it's typically, so if everybody is talking about how well GK is doing and they're having a great year and solid year financially, and you see it at $90, $95, to me,
you're chasing it. That's the markup fees.
Exactly. So if it is that I'm interested in GK, they've turned things around, I'm looking at them, I'm waiting until the steam has died out, and I'm willing to bet, I'm always willing to bet that I can get it at a reasonable price, because this is what people don't understand. Stocks trade within a particular range. It may start the day at 90, end the day at 100, but maybe traded at 85, maybe traded at 80, maybe traded at 102, but it ends the day at a certain price, and persons think that, hey, if I don't buy it now, tomorrow it may be 110. And that is the benefit you have of kind of controlling your own trading. And that's why we advocate for persons to do their research, understand it. And if you're interested in trading, I wouldn't be relying on somebody else to trade for me. But if you're investing, you can say, buy that stock at market price and it's fine. But if you're trading, you really want to just take a little bit more control, because there's a spread that the stock would typically sell for. So it will trade somewhere between maybe, negative 10%, positive 10%, sometimes usually within a week range, but nobody kind of sees that, because they'll say, oh, it's up 80% this year. Yeah, but along the way you could have bought it, at a good price.
Yeah.
Taken
if you watch that how it moved during as the term is used, intraday trading, where basically it has a band, it moves up and down in, so you could have slotted yourself in at that point in time. I see that's the thing. I mean, while I have an understanding of it, is that the level of uncomfort. It's not uncomfortable. I mean, the truth is, I just don't feel that.
That's right.
Companies are companies. That's why I prefer to use the term company than use stock. I like the idea of owning and holding good companies and them doing what I expect them to do within the timeline that I want them to do it in, or expect them to do it in, right? And leave when I feel to leave at that point in time, etc. So yeah, I fully get that. I fully get that.
So Joshua is asking, and this is our final question we're taking, guys. We're gonna wrap up after this. Joshua is asking how to value USD stocks and the JSE market. Are you meaning how you do the valuation of those companies? Because the valuation process is the same.
It's the same. And it's just that understanding that USD stocks, USD companies don't move. They're not as volatile the GMD. Well, actually, they're actually not really. I don't see them moving like that. They have their
Well,
reasons when they.
the truth is I don't track them. I know David,
Yeah,
speaks a lot about trading on the US side. It's usually it operates within a different range, I would say,
yeah.
right? As I see Chris here sharing that you buy the train before it leaves the station, not when it's almost at the destination. I
Indeed.
actually don't. No, I don't agree with that because if you think of a stock reaching a destination, what you're implying is that it's too late. If my time horizon is 5 years, is it too late?
Yeah, we always get, well, you and I would, that's a whole different other conversation that we always get, because I keep coming back to, if you're doing your analysis, you try to and you understand what you're looking at. As you rightfully said, you buy when everybody's not talking about it. And if you understand your analysis, you're seeing what others will see later on down the line. You're not trying to jump in the water when everybody has already waded in there.
Yeah.
I stick by the principle. I stick by the principle that when everybody's getting in, I'm actually looking to get out, right? So, I mean, that's just. And if I want to get back in again, I get back in as you said earlier on, when all of the hype and everything has died down about it, because as you said earlier, stock companies, economies, they go through cycles, right? They go up, they go down, they come back to a reasonable price point. So one of the things is you should never be overpaying if you know that you don't have to be overpaying, right? So why would you, right? Just think of it. You go out looking for bargains when you buy clothes, when you buy a car, when you buy anything else. So why are you deciding that you're going to overpay for a particular company, a stock, etc.? Knowing full well that you believe not knowing, but believing full well that you're overpaying for the company. It doesn't compute for me. So I like to get in before everybody's talking and get out when everybody's talking. When everybody's talking about, that's when I take my profit. And to go with that train statement, as I said earlier on, and I didn't say it, it was said that the profit is in the purchase, not in the sale, right? So I like to keep it that way.
Yeah. All right, guys.
See, Fitzroy is with. Yep, there we go. That's the margin of safety Buffett rule right there.
All right, so let's Xavier is here. Shout out to Xavier. Hopefully we'll be able to have him join us again soon. He says that I think in that case you have to also know if you're buying into a company that's a dividend stock or a growth stock as well for the train station scenario. Yeah, exactly. So I mean, it depends on who you look at. I'm careful of my analogies, so I understand what Chris meant, but I also want persons to not think about it the wrong way. When you say destination, it could give, because that's what feed into this fear that I need to buy the stock now, and then you buy you buy Siboney at $2 and then now it's at 80 cents because you think
that's not good,
right? No, I have to go there, and that's because so what I do personally is when I hear of a stock doing well, I look at the point at which I'm in. So if I hear about the stock doing well, and then I look and maybe for the last 4 days, it's up 40, 50, 60%. If the stock is close to doubling, I am really going to consider whether or not it makes sense.
It can go more. Yeah.
So if it is doubling with anticipation for results, and it's not guaranteed that results are good, because if you look at Mailpack, for example, Mailpack was getting some good momentum, and then persons are like, well, fair value for Mailpack is $4. So those who were on the train early, using the train example now, be on the train early,
met their destination.
Somebody had to buy at $4 anyway.
Right.
The persons who bought at $4, it's now $3.40. They're like, well, I missed it, and they're wondering now why Mailpack not doing well anymore, why this is happening, why that is happening.
And it's not about that. it's just the momentum, correct? Right? It's just a cycle. It's not about the company not doing well. It's just the momentum of the market price of the company that has changed for now, right? If you give it its time, it will do this. It will come back to doing it again. So
which is why I say, if it is that a company is brought to my attention because it's doing well, I'll seriously take a look at it, wait for the hoopla to die down, and then I'm saying, okay, cool. If it has strong financials, if I'm thinking that, okay, 3 months from now or X number of time from now, it would make a good stock, and I enter it now, I'm buying up under the quiet. Nobody's talking about it. The train has left, and I'm here chilling. And in a few months, when everybody's finding it and it's hot again, then I'm like, okay, I'm good, because I would have bought in the moments when it's losing that momentum, when persons are exiting to try and get into the next best thing. I'm just kind of chilling because I'm benefiting from those who maybe bought at 4 that's selling now at 350, or maybe those who bought at 250 and taking their profit. Either way, I'm benefiting, not buying at $4.20 or buying at $4. I'm buying at 350, 325, $3, because I know that it's capable of getting there, or the momentum is enough to carry it there. Then I can enter that position, get benefit from the dividend that was paid recently, and then I'm good in a few months. So that's just kind of how I process these things, because I'll never buy into somebody saying it's too late. Did the company stop doing business? Did the company stop,
or did it delist from the market? Yeah, as long as it's
Exactly. All right, so I want to shout out the guys from 876 who joined us tonight. 876 Invest, that was Nicholas and Justin. Guys, take a moment and check out 876 Invest YouTube channel, subscribe. I'm sure they have a lot of good things coming up. Yes, Akeem, definitely. You know, when there's an opportunity to buy, you want to take advantage of it. Guys, we have a special episode coming up this Saturday. We have an all-female session for in honor of Women's Day coming up. We do believe and encourage the women in our community to invest, to learn about investing, to become knowledgeable, to share their feedback and input. I say it all the time, some of the best investment ideas and strategies came from my wife. So she has a sort of eye for some things. She does not care about investing as much as I do, and that's fine.
Yep.
But she has the ability to sense things that could be, you know, something that I don't see. So we definitely want to hear a woman's perspective, because I think you'll benefit from it equally. So join us on Saturday. Please, we're asking you to share the video. We're trying to get to 1,000 subscribers, but it's not really about the subscribers, honestly. It's really about us growing and building our community. It's about you finding value. And Chika, any final words before we sign off?
I think you've covered it fully.
All right, guys, so thank you. Please, we're asking you to leave a comment under the video. So what you've been speaking in is a live chat, but we want you to leave a comment below the video and tell us what was your takeaway from the session here tonight.
And also if you have any
questions?
your questions, or you have ideas as well too, in terms of you know, let us know.
Yes, ideas of topics. Tell us whether or not you're going to diversify or concentrate. Tell us in the comments below. And we're asking you to share the video with at least 10 persons. Each of us know at least 5 to 10 investors. Share it with them, and we'll see you on Saturday. Yes, Joshua, thank you so much for joining. Really, really appreciate it. All right, guys, take care.
All right, guys. Bye.